All catastrophic psychological capitulation starts simple: a single thought, a simple emotion, a simple impulse. And the thought, emotion, impulse automatically spirals into a cascade of catastrophic losses. These impulses are so automatic that they are subconscious. They are so subconscious that you won't even be aware of what's happening until the damage is done. I was talking with a trader named Chris last week after he'd just blown his account. And in hindsight, he admitted that it wasn't his strategy's edge that failed him, that it was his weak trading mindset. And I believe that after hearing his story, you'll agree with him. Chris was trading the euro to US dollar like he's done for more than 2 years. He'd been consistent, disciplined, structured, and methodical in his approach to trading the EUR/USD pair. He'd funded $300 and used only 0.5% of his bank per trade. He was journaling his trades, reviewing his journals, and learning from his mistakes. The only hiccup on this 2-year Euro-USD journey was that he'd only made a measly $25 profit over that 2-year period. One day, he was on YouTube and he stumbled on a video on the Kelly criterion. The trader who made this video talked about complex mathematical formulas. He showed historical bar and pie charts, and it all looked very sophisticated. The trader said that this was the secret of how the big boys, the hedge fund guys, the institutional traders, manage their risks to maximize capital growth. The trader said the big boys don't use flat risks. He said using flat risks is for wimps. The big boys size based on their edge, an edge they've known so well over the years. The advice sounded good, the video production was clean, sophisticated, and professional. The trader, in his $1,000 suit, managed hundreds of millions of dollars in assets for institutions. Or was it that he knew traders who managed that kind of money for institutions? Or was it that he used to manage funds like that? Chris said it was all so blurry. But any of that didn't matter to him. What mattered was that he sounded like he knew what he was talking about. So, after watching the video, Chris thought to himself, well, I already know my strategy, the technicals, my edge, my A-plus setups. Why not leverage the Kelly criterion and increase my stake on my A-plus setups? After all, if I continue like I've been doing, when will I become as successful as the Kelly criterion guy? So, at the beginning of this year, he increased his risk per trade from 0.5% to 5%. January and February were smooth sailing. He was winning some and losing some, but he was cutting his losses short and maximizing his profits. He was executing his A-plus trades to perfection. In those first 2 months, he made $75 on his bank, which was triple what he made in the previous 2 years combined. Better days were indeed ahead. But on a fateful day in early March, he got stopped out of a trade. The U.S. Israel and Iran war had commenced, and the market was going crazy. It will take some time for the market to adjust to the new reality, so this loss was normal and he didn't even pay it no mind. But over the next couple of days, the next trade he entered was another loss. He's now had 2 losses back to back. This was still nothing to lose sleep over, so on his next trade, he made sure he tightened his entry criteria. He wanted to catch a cleaner setup. He didn't want to force the trade. He was patient for days, waiting for the trade to tick all his boxes. And this trade did tick all his boxes. So, with full confidence, he entered the trade like he always did, set his stop loss and take profit levels like he always did. Only this time, the market went against him again, and he got stopped out again. Now that's 3 losses in a row. He's not had one of those in a very long time. When he was about to go to bed that night, he ruminated on the amount he's lost over those 3 trades. $45. Wow, they do add up fast, he thought to himself as he went to bed. The next morning, he was fresh and had a clear perspective. He did his analysis, had a feel for the market and what he planned to do that day. Later in the day, he entered another trade, and after his entry, news of a ceasefire violation dropped, the market went haywire again, and he got stopped out again. Now he's worried. Now he's sweating. 4 losses in a row? $60 loss? He'd almost given back the 2 months' profit he'd painstakingly made. And then, just as he was about to lose hope, he saw the retracement. After all, the crash had to retrace at a point. This wasn't his normal trading strategy, but this was free money. He entered, and the market did reverse for a bit. Let me maximize this opportunity, he thought. Let me allow the trade breathe. So he set a more accommodating stop loss and a much higher take profit. And just like he predicted, the market reversed and he made almost $55. Wow, now I'm back. I took a big risk, but it worked out, and I won't do it ever again. I'll go back to my trading plan. The following day, the market was all over the place, and he shouldn't even be trading till the market decides where it will move. But he saw a half-ish A+ setup, more like a B setup, and he took the trade anyway. After all, what's A+ about this crazy market these days? Well, the trade ended in another loss. As he wanted to close TradingView for the day, he saw the retracement starting to form again. He mused, rubbing his palms together. Let me take the free money again to make up for today's loss, like I did yesterday. Maybe it's even time I add this retracement strategy to my trading portfolio. Again, he entered with a very accommodating stop loss and a huge take-profit point. High risk, high reward. Only this time, the market continued its freefall, and he got stopped out at negative $120. By now, he was sweating again. He can't afford to wipe out all the effort, all the discipline that's gone into more than 2 years of his life in just a single trade. In for a penny, out for a pound. After all, the market must retrace at a point. So he entered the retracement trade again, only this time with the remainder of his bank. And that was how Chris's account met with a catastrophic end. Chris had everything on lock for years, and the simple thought of a $45 loss being unacceptable led to the collapse of his trading psychology. His trading mindset went from strong to weak in an instant at the drop of a $45 loss. Chris told me on the call that he'd been following his original strategy after those losses, and it's back to winning ways. Admittedly, the win rate had reduced a bit, but if he'd stuck with it, he'd be okay. If you were to learn from Chris's story, you'd know that if you want to become a successful trader, you must build an impenetrably strong trading mindset and psychology. Because as you can see, it won't be your strategy that will fail you. It won't be your knowledge of the market. It will be your weak trading mindset, which crumbles when market conditions become unfavorable. So, how do you build a strong trading mindset? Before we get into learning exactly how to do that, we need to first get clear on what a strong trading mindset means to you. So, what does a strong trading mindset mean to you? Is it the trader that's able to win big and extract the most money from the market? Is it the trader that lasts the longest in the market? Is it the trader that knows everything there's to know about the market? The trader that's seen it all and knows every possible scenario that can unfold? Is it the trader like Jesse Livermore who keeps coming back again and again after losses and simply refuses to quit? Is it the trader that has access to insider information on what will happen in the market? Is it the institutional traders, the hedge fund guys, the traders who manage millions of dollars? What's the metric that determines whether a trader has a strong trading mindset? Well, here's a simple explanation of what a strong trading mindset looks like. It's a trader who's able to keep a calm, rational, and level head when market conditions go against him. It's easy to be strong in fair weather. The real test of who you are psychologically is when things go to shit. So think back to the last time the market didn't follow your plan. Did you get emotional? Did you lose more money than you originally planned to do? That's the signal that you have a weak trading mindset. Right now, you're probably thinking, "Oh God, I'm down really bad. My emotions are always all over the place. I'm under a lot of pressure and stress right now. Can I ever break this cycle? Am I doomed?" Here's the good news. Nobody, and I repeat, nobody, is born with a strong trading mindset. You can learn to be resilient and composed when you trade. Although the psychological capitulations we've been discussing seem automatic and subconscious, you can train your body to react with resilience and composure. Our subconscious mind runs our body. It's in the driver's seat, guiding our bodies through automatic reactions and impulses. And the traders with the strong mindset are those who have trained and hence can control these automatic impulses the most. So, to build a strong trading mindset, you need to train your subconscious automatic impulses. And to do that, you must understand the relationship between your habits, your subconscious mind, and your impulses. Repeat a habit over and over and over again at the conscious. With time, it gets handed down to the subconscious. In other words, our habits feed our subconscious, and our subconscious feeds our impulses. So, to rewire your impulses, you need to change your habits. Chris's automatic impulsive response to the $45 loss was to make it back instantly. So, as he saw the retracement, he traded it automatically, without conscious thought. But another trader's frontal brain, with better automatic impulses, will override that response with something like, "You haven't tested this strategy extensively. How do you know this one trade won't go against you as you risk everything?" What are those habits that build a strong trading mindset impulse? It doesn't matter if they scalp, swing, value invest, or crypto trade. All successful traders with a strong trading mindset impulse have these 4 habits. 1. They always have a trading plan. 2. They always manage their risk strictly. 3. They are masters of their emotions. And 4. They continuously learn and adapt. I call these 4 habits of the successful traders the Big Four. On the surface, these habits are no-brainer habits that all traders should aim to develop. I know you've heard of these habits a million times now. They're well-known attributes of a successful trader. It's not like I'm breaking a super habit invention ground here. You've probably tried to get them to stick several times in the past. A lot of people smarter than you have tried to make them stick several times in the past. But why is it that at the end of the day, only 5% of traders are successful? Why is it that 95% of traders can't get these habits to stick? There are 2 main problems why most traders fail to be consistent with these habits. The first problem is that these habits are too abstract in this form. They are devoid of daily actionable to-dos you can repeat over time and make subconscious. For instance, many videos you've watched will just tell you, "Go and master your emotions, and you'll be a successful trader." With this type of advice, you're left scratching your head and wondering, but how? And you'll be right to be confused. That's too abstract and vague of an advice. The second problem is that most people separate these habits of the successful trader from who they are in life. Life doesn't work that way. How you do anything is how you do everything. Think about it. A trader who trades without a trading plan will probably be going through life without a plan. I've never met you in person, but I know that if you're the type of trader who trades without a plan, or abandon your plan halfway, you're probably a person who can't tell me what you're doing tomorrow to the hour if I ask you today. You're probably doing a job you don't love, or at the very least passionate about, because life's wind just blew you to that job. A trader who doesn't prioritize risk management is a gambler at heart. If I look at your relationships, both intimate and otherwise, you probably take a lot of risks with those too. You're probably the guy who does the horizontal boogie without using a condom when you know you should. A trader who hasn't mastered emotional control is highly likely reactive in his personal life. Your wife might say the smallest of things and you get highly emotional. You're probably easily emotionally rattled when life throws curveballs at you. A trader who isn't adaptable is probably nonchalant about learning in his personal life. You probably don't read. And even worse, you probably make fun of people that do. You probably don't react well to feedback and criticism. You probably get tensed up when people say things you don't agree with. I'm saying all these to show you that there's no separation between the person and the trader. So, if you're struggling to master the Big Four habits I just listed, that means you do need to change the person first, and then, and only then, will the trader follow suit. So, how do you change the person? You first need to know the person version of the Big Four, and after that, break those person versions down further into the daily, actionable habits that will now translate into the trader version of the Big Four in the long run. To figure out the person version of the Big Four, the question is simple. Who is the person that always has a trading plan, always manage risk, always in control emotionally, and always learn and adapt? In other words, if you met a trader that does the Big Four habits consistently, and you had no prior idea who he is in his personal life, and you're told to write a short biopic on who you think he is, what would you say about his personality? The answer is 1. His fundamental philosophy of life supports the Big Four habits. 2. He's emotionally in control. And 3. He's a disciplined person who follows through on his daily practices. A disciplined person is a disciplined trader. I know you're scratching your head again and thinking, but wait, isn't this person version of the Big Four even more abstract than the trader version? You're right, they are. But knowing this person version is easier to work with on the neurobiological level. In other words, this person version is easier to structure into a daily habit level. And without further delay, let's get to structuring. The habit of building the right philosophy for life and trading. The fundamental difference between the successful people and the failures of this world is their philosophy. Your philosophy is the lens through which you see life, and this lens doesn't just appear out of nowhere. It's the culmination of your experiences, your environment, what you interact with daily, and your convictions. A distinct philosophy for life that always intersects with trading and affects the mindset of traders is the fallacy of the quantum leap. You know, the cliches, the overnight success narrative, the win big mentality, the get rich quick and easy schemes that saturates our culture and media, the something for nothing approach to building wealth, the gurus, the trading maverick stories we grew up on, the he made $200 million on a single trade stories. At a certain level, you've probably subscribed to this philosophy. We all have, at a point on our trading journey. Here's the bad news. If you're still subscribed to this philosophy at any level, you'll never make the Big Four trading habits stick. You might talk a big game on how you'll always have a trading plan, how you'll always manage your risks and not blow up, how you'll not get emotional when the market goes sideways, how you'll adapt as the market evolves, and you might even do it for a while. But once the market goes sideways and that philosophy kicks in, you'll blow up. Chris was diligent in the Big Four habits for 2 years, but a part of him still subscribed to the philosophy that he should be able to make more money quicker without any emotional cost. And once that philosophy of get rich quick and easy kicked in this year, his trading mindset collapsed like a house of cards. So, how do you change a philosophy? It's simple, really. All you need to do is reinforce the new philosophy by gathering as many proof of its validity as you can. Look for traders who have used the new philosophy to become successful in trading. Watch contents that reinforce that new philosophy daily. And together with all of that, you need to become a practitioner. Test the new philosophy by doing it over and over again yourself. And it's in the act of practicing that you start building beliefs and convictions for the new philosophy. So, what's the new life and trading philosophy I'm trying to sell you today? It's the philosophy of the slow, but most importantly, the steady winning the race of trading and life. A case for steady winning the race in trading and life. Wealth is rarely created overnight. Hold on, let me rephrase. Real and lasting wealth is rarely created overnight. I know you're probably thinking of that 1 in 1,000 outlier trader right now. I can already hear the whimpering in the comment section. I hear you, but there's a trader I also heard of somewhere who threw the kitchen sink at an opportunity and made $200 million on a single trade in a single night and got rich for life. Well, I'm here to tell you that that's all he is, an outlier. For the 99.9% of the remaining successful traders that exists on this planet, strict risk management, having a solid trading plan, controlled emotions, are the vehicle that takes them to success. The only use what you're comfortable losing to trade with philosophy is the norm. Whatever else philosophy you've subscribed to about trading is the outlier, an outlier with a 0.01% chance of occurrence. In other words, for Chris to be a successful trader, risking 0.5% that he's comfortable losing is the norm for his success, and the Kelly criterion is the outlier. Pre-market preparation, eliminating guesswork, preventing impulsive, fear-driven decisions, strict risk management, and consistency almost always outperforms sporadic, high-risk strategies. But risking 0.5% is a drag. When will I get rich doing that? When I'm dead? That's the common mental barrier with adopting this new philosophy. To help you break through this barrier, I want you to meditate deeply on the following case studies as proof of the validity of this new philosophy I'm trying to sell you. 1. The richest and most successful trader in the world, Warren Buffett. Although we can't really pinpoint exactly what he risks per trade, we can deduce it from what we knew about his trading results. Out of almost 500 investments he's made over the course of his life, only about 12 drove 85% of his total gains. That means only about 2.5% were a massive hit. Of all his investments, statistically, there would be the modest winners in there and some break-evens. But statistically, it's safe to infer that more than 70% are losers. That's 350 investments that lost him money. What is the distribution of those losses? No one knows. Not even Warren Buffett himself could have predicted the sequence of those 350 losses. And that's why his advice on protecting your capital at all costs as the most important facet of trading now makes a lot of sense. I'm sure there'll be years where all his investments just kept losing and hemorrhaging money. And if he'd been using the Kelly criterion, say about 5% of his total capital per trade, he would never have been able to weather those market storms. He would have been taken out of the market and would not have become the most successful trader of all time. According to studies conducted on self-reported and known successful traders of this world, it's been found that they only risk 1 to 2% of their capital per trade, and the uppermost limit of risk per trade is just 3% of their capital. This is cold, hard facts staring you in the face, and facts don't care about your feelings. Facts don't care about your intelligence and how well you think you know the market. The most successful traders only trade with what they're comfortable losing. This is their philosophy. 2. The world's largest hedge fund, Bridgewater Associates. If you're not an extremely conservative trader like Warren Buffett and his advice on only trading assets you know really well doesn't resonate with you, then Bridgewater Associates might be the perfect case study for you. Ray Dalio built the largest and most successful hedge fund on a principle of investing in extremely diversified assets to mitigate risks. The hedge fund employs sophisticated algorithms to locate these parallel, non-related assets. But beneath all the systemic, sophisticated randomness is the underlying core philosophy of strict risk management of only risking 1 to 2% of their capital per trade. And mind you, these are the big boys. This is the hedge fund, the largest and the most successful in the world till date. 3. The most successful trader's relationship with time and consistency. Our culture's relationship with time and consistency is warped and psychologically distorted. It always amazes me how distorted it is. It's like some time-warping quantum magic wormhole shit. We are always sold the quantum leap fallacy because it sounds better than the truth. If I say Warren Buffett is the most successful trader to ever live and that he's worth $1 bajillion, this sounds better than the truth that he started investing at the age of 11 and it took him over 40 years to acquire 99% of his $1 bajillion. Still on the legend of Warren Buffett, I can easily sell you on the fallacy that Warren Buffett just woke up one day and decided to invest in Coca-Cola, and he now makes a massive $816 million annual dividend return in a couple of years. But the true version is that he started buying following the 1987 market crash when everyone else was fearful and won't touch the Coca-Cola shares with a 10-foot pole. It took him 6 years to complete his position in the company and another 20-odd years to start earning the figure I quoted above. And of course, the first version again sounded better and would likely motivate you to invest in Coca-Cola shares when you're done watching this video. Have you seen how different two versions of the same story can become? What differentiated these stories was that I added the time and consistency cost to the second versions of the stories. Remove the time and consistency factor from any trader's success story, and poof, just like magic, you create the psychological distortion that success is fast, painless, and easy. But if you want to rid yourself of this messed up philosophy, all you need to do is lift the veil and dig a little deeper. From now on, any trading success story anyone's trying to sell you, always ask the time and consistency question. And you don't even need to dig a lot. A little bit of asking the right question on Google will reveal the deeper philosophy. For the sake of my trading psychology, and because I genuinely care about you guys, I did a little digging on all the successful traders that's prominent in our culture's consciousness. And it was quickly revealed to me that all of them took years to learn the craft of trading and are super consistent with whatever strategy they've chosen. They adapt the strategy as market evolves, but they rarely strategy hop. Just like Warren Buffett, Ray Dalio started investing at the age of 12. He started Bridgewater Associates at age 26, had early success, suffered catastrophic financial losses at age 33, and after that, rebuilt the whole company from the ground up. That's almost over 13 years in the trenches before it even neared sustainable success. Paul Tudor Jones had his massive success in the market after more than 10 years of total market experience. Stephen Cohen spent more than 6 years trading before he was handed $75 million in management by a fairy godfather. And his company SAC had more than 20 years of an average of 29% annual return rate. Good, right? Turns out, no. It wasn't good at all, because SAC ended up pleading guilty for insider trading for those returns. Insider trading is a can of worms I've deliberately chosen not to open right now. But it did come up a lot when I was researching the big boys, if you know what I mean. Just thought you should know, for educational purposes. And Stephen Cohen still bounced back, created another hedge fund, continued whatever the fuck he was doing, absorbed SAC, and is still thriving. I could go on and on and on, but their consistency and the timeline of their success being over 6 years minimum stayed the same across the board. And yet, when you finish watching this video, the next video reel you'll see will tell you that speed is important to success, that time is of the essence, that you have to act now, that if your strategy isn't working anymore, you should hop on to this next one, that market opportunities are limited. They are here today, but gone tomorrow. But I hope that these short case studies have shown you that the only trade what you're comfortable losing philosophy is valid and holds up. If the biggest and best traders are using just 1 to 2% to trade, why won't you? If you think about it, your 0.5% might be small now, but with time, if you adopt this new philosophy, your 0.5% might be thousands and hundreds of thousands of dollars. I hope that by watching this video till this point, you've had a paradigm-shattering moment, an eureka moment, that has shattered the mental barrier you might have had to this new philosophy for trading and life. If you're sold on this new philosophy of approaching trading and life, like the video and comment Eureka in the comments section. Comments help the video reach more people. To solidify this new philosophy, you need to watch more content like this on this topic. You can do that by watching the video up here where I go deeper on the illusion of time on trading success. I will also link it at the end of this video and the description of this video. You should also subscribe to our channel for more contents like this. Listen to other podcasts that discuss this philosophy. Stay away from the Make 2 Million in 2 Weeks videos. And after that, start practicing the remaining 2-person daily habits we will discuss for the rest of this video. Emotional control. Every trader's Isildur's bane. Contrary to popular belief, a trader who lacks emotional control isn't someone who can't restrain himself when he enters or exits the markets. Because if you can't logically enter and exit markets without getting emotional more times than you can count, then you have no business being a trader in the first place. Lacking emotional control as a trader is much more sinister than you've previously believed. On the surface, a trader who lacks emotional control is even the calmest and most rational trader in the room. He's the one that talks the biggest game about trading discipline. He's someone like Chris that will talk your ear off about trading plans, advanced risk management strategies, and how he's been consistently emotionally controlled in the markets for more than 2 years. But ask him when he last blew a trading account and he'll say something like, "Well, I blew an account 2 months ago, but it was just a test run account for some strategy I'm testing out, and it wasn't even my fault, it was the brokerage firm and their slippage that blew my account." But if he was honest with himself, if we as traders are honest with ourselves, we all know deep down that no matter how high our win rate is, no matter how long our strategy is consistent for, no matter how disciplined we've been in following our trading plan, and no matter how much we've extracted from the market, we all know that a day or a week of reckoning is coming. A day or week where all logic will fly out the window, where the emotions of greed, fear, and desperation will take the wheel. A day our limbic system will override our prefrontal cortex. A day our accounts will eventually get blown. You know the day I'm talking about. You've experienced such days in the past, and you know in your heart of heart that that day is always on the horizon, patiently waiting for you, patiently waiting for all the profits you've made, patiently waiting for your trading capital, and more. And more? What else can that day take from me aside from my profits and trading capital? What else have I got to give? Well, this is the day most traders lose their confidence and, most importantly, their will to keep going. This is the day the market takes the soul of most traders. It is this day that separates the failures from the traders that will end up succeeding. And this is the day where you have the rare opportunity to prove to yourself that you indeed have a strong trading mindset. Remember, as I said at the beginning of this video, all catastrophic capitulations in trading start with an impulse, and it's easier to control your emotional impulses in fair weather. The real metric of how emotionally controlled you are is how you fare on days like this. It's until you experience days or weeks like this in the market and you were unchanged in your approach and you didn't lose more money than you initially planned to, that you can confidently come out and say your emotions for trading is under control. I call these days and weeks anchor points. They are the points in time that defines the trader. So, to build the habit of emotional control for these anchor points, you have to understand your emotional impulses to adverse trading conditions. Think of these anchor points as an Olympic finale event, the event that defines the legacy of the athlete and determines whether the athlete wins gold or go back home empty-handed. You can't expect this kind of event to be a walk in the park for the athlete. The athlete can't be in hibernation for years and rock up to that finale and expect to win gold. No, it doesn't work that way. Michael Phelps, the most decorated Olympian to ever live, dedicated his life to training, to performing, for those rare anchor points where he broke the world Olympic gold record by beating Milorad Chavich by just 0.01 seconds. The athletes that win, train, perform, rehearse for those anchor points that give them a slight edge over their opponents to earn the gold. And just like the athlete, you need to train, perform, and rehearse the emotional circuits in your brain to prepare and have a slight edge over the anchor days and weeks in trading. Every day, you need to literally and physically train your prefrontal cortex to get structurally and physically bigger than your limbic brain, so that when you're staring at your screen on anchor days, your prefrontal cortex remains in control. That's how you become emotionally in control. Thankfully, anybody can learn to become emotionally in control because our brain is plastic in nature. This means your brain structures can be trained, molded, broken down, and grown in any which way you want. So you need to neurobiologically, physically, and literally reprogram your brain for emotional control. What I'm proposing is a habit that you do every day as your own form of training, performance, and rehearsal for the anchor days of trading, so that when they do occur, your limbic system can't hijack you. So what is that daily habit I'm proposing you do every day that gets your prefrontal cortex bigger and simultaneously reduce the charter of your limbic brain? Well, there's only one habit that scientists have found to do this both effectively and remarkably well, and that habit is meditation. The habit of meditation is simple. In fact, it's the simplest habit in the world. Just sit down for 5 minutes and do nothing but focus on your breath. That's it. That's meditation. But you won't do it, at least not consistently. You know why? Because of your philosophy. Remember philosophy? That topic we've been discussing extensively over the past few minutes? Why you won't meditate regularly is because you're not sold that it will help you build a strong trading mindset, let alone help you become a successful trader. You think meditation is this woo-woo stuff that only monks in the Himalayas do. And I kind of understand why you hold this philosophy about meditation and trading. In the past, when you've heard about successful traders, meditation isn't what a lot of them credit for their trading success. And truly, meditation isn't for every trader. But if you concur that to be a successful trader, you need to have a strong trading mindset, and part of having a strong trading mindset is not getting emotionally hijacked in crucial moments, and you are the type of trader that always get emotionally hijacked in crucial moments and blows accounts or lose more than you planned to, then you are the type of trader who needs meditation the most. How our brains are physically structured in relation to the prefrontal cortex and the limbic brain is different from person to person. These differences are down to genetics and environment. Some people are predisposed to a bigger limbic brain than others, and some are prone to a bigger prefrontal cortex than others. The tricky part is that our prefrontal cortex doesn't fully form till we are 21 years old, and from birth till you're 21, your experiences, your habits, your addictions, your environment, all influence the formation of your prefrontal cortex. That's why some people are much more prone to certain addictions and not others. That's why some people are more emotionally impulsive than others. Remember the word impulse that we've been using from the beginning of this video? Well, it's this brain structures that dictate your impulsive reaction when shit hits the fan in the markets. It all boils down to if the executive reasoning part of your brain, your prefrontal cortex, can override the impulses of your fight or flight circuit, the limbic region of your brain. So, if by your genetics, your environment, your habits, or your addictions growing up, your prefrontal cortex isn't more developed than your limbic region, and you find yourself later in life always blowing trading accounts, then you need to become a regular meditator. Meditation is the easiest and the most effective way to build up your prefrontal cortex, to better control your emotions. To further philosophically convince you to take meditation seriously, here are some popular, successful traders that credit their trading success to meditation. Ray Dalio, the founder of the most successful hedge fund in the world, was once quoted saying, "Meditation was the biggest ingredient of whatever success I've had." Other prominent successful traders that meditate regularly include Bill Gross, George Soros, Chris Capri, and so on. In addition to all these, you can go online and search for the effects of meditation on emotional control. There you'll see thousands and thousands of research supporting the role meditation can play on your trading. As I said earlier, meditating is easy. Just sit down for 5 minutes and do nothing but focus on your breath. Your mind will wander, it's normal. That's your limbic brain's chatter. Just bring your attention back to your breath. The more you meditate, the better you get at meditating. And when this happens, you'll start increasing the length of your meditation. And with time, you can start doing advanced meditation techniques for traders, like the transcendental meditation that Ray Dalio does, or the money story rewrite meditation a lot of traders do. The habit of discipline. Just like the habit of emotional control, a disciplined person isn't someone that sticks to a routine or a habit for a long time. Rather, a disciplined person is someone who does a routine or a habit when he doesn't feel like doing it. That's the caveat to building discipline that most people don't know. Doing things when you don't feel like it is what structurally, literally, and physically builds the region of your brain responsible for willpower and discipline. And this region of the brain is known as the anterior midcingulate cortex. This region was recently discovered by neurobiologists, and there have been a lot of studies conducted to definitely prove that this region is the seat of not only willpower, not only discipline, but even our will to live. So, doing hard things when you don't want to builds this region. The more you do hard things when you don't want to, the more your capacity to be disciplined and do other hard things on a more consistent basis. But the anterior mid-cingulate cortex is like silly putty. When you stop doing those difficult things you don't want to do, it shrinks and gets smaller. And eventually, the capacity you've built to be disciplined vanishes. For the purpose of building your anterior mid-cingulate cortex to become a disciplined person who consistently follows through on the big 4 trading habits we listed earlier, I will now give you the one habit that you can do every day, which will eventually turn you into a disciplined trader. After several studies on the anterior mid-cingulate cortex, scientists found that the one habit that builds this region the most over the shortest period of time is regular physical exercise. Think about it. I don't think there's anything our bodies hate more than constantly exercising. When you exercise, your body is forced to move, to lift, to bend against its will. And while you're doing that, your body hurts, burns, and breaks. And the next time you want to do it again, no matter how long you've been doing it, your body makes a strong case of why you should just sleep in and not do it. And much more damning, the rewards of constant are delayed. It's after you're done exercising that your body secretes feel-good chemicals like endorphins and dopamine. And it will take you months or years of consistency to reap any major health or appearance benefits. And this is why the majority of people in the world do not exercise regularly. It hurts, and the bulk of the rewards are delayed. Hence, regular exercising is the one habit that builds the anterior mid-cingulate cortex the most. How to get into the habit of regular exercising? To start with, you don't need to go and register at the gym and start training for a bodybuilding contest to reap the anterior mid-cingulate cortex benefits of exercising. But if that's what you intend to do, then by all means go ahead. But it's better not to overwhelm yourself if you've not been consistently working out in the past. You can start with just 10 to 15 minutes of high-intensity training or running every day. Then, from there, you can graduate to running for 20 minutes, or lifting, or even push-ups, pull-ups, and calisthenics. I can't choose your workout regimen for you. No one can. Only you can choose what you know you'll at least enjoy a little bit so that you'll stay consistent with it. Any exercise routine you end up doing doesn't have to be every day. You can be doing every other day or 3 to 4 times a week. But as a rule of thumb, for consistency, you don't want to miss 2 days in a row. Also, I have to mention that one thing that won't work is walking. Walking as a functional human is pleasurable. It's not something we hate to do. So unless you're like 90 years old, just walking as a means of exercise won't build your anterior mid-cingulate cortex. So go and try different forms of exercise and pick the one you'll be consistent with. Best of luck. 4. On continuous learning and adaptability. If you could have a superpower in the world, what would you like it to be? Ability to fly? To be bulletproof? To be fast as Flash? For me, I think the best superpower I could have is the power of reflection. A superpower that could make me go back in time and correct my mistakes, do things differently, and position myself to win, because I've literally lived the moment before. God, I will be king of the fucking world in like a week. I know going back in time and correcting my mistakes would create nasty time branches and mess up this timeline. I know that the natural order of things would fight back and everything will get fucked, but wouldn't it be cool if I could pull it off successfully? Enough geeking out on you guys, but what if I told you that you already came into this world minted with this superpower, without all the nasty consequences wielding this power could have? Every living human, so long as you have a functional forebrain, has the power to reflect. This is the power to continuously learn, continuously collect data, and continuously reflect on the data so as to adapt to what might be coming. It is this superpower that's allowed the race of men to build advanced civilizations, make great inventions, reduce poverty to the lowest it's ever been in our history, get to space, and now thinking of colonizing Mars and our moon. We collect knowledge, act on that knowledge, fail forward, learn from those failures, and get better as a consequence. This is the superpower of successful traders. They're not smarter than you, they're not better people than you, They just acquire knowledge of the market, try out the knowledge for a long period by protecting their downside through strict risk management, and reflect on the outcome for future trades. And this is a habit you need to build to become a trader with a strong trading mindset. Continuously learn, reflect, and adapt as markets evolve. Do this over and over again, and it becomes second nature. Test your strategies by trading them live and documenting the outcomes. Then reflect on those documentations. Your reflections might be a weekly thing or a bi-weekly event, and as you found enough proof of evolution in an aspect of the market, adapt and position yourself to take full advantage of the change that's coming, almost like a time traveler. And the one habit that helps you sharpen your reflection skills is the habit of journaling. Get yourself a journal. It can be a digital or a physical one. Learn to record your trades. Learn to record your state of mind and emotions pre-trade and while you're in the trade. This is the habit you do on a daily basis to become a time traveler. So far, I've gone the long route just to show you that as a trader you need to 1. Update your philosophy about life and trading by watching videos like this every day and acting on what you learn. 2. Meditate regularly. 3. Exercise regularly. And 4. Journal your trades. But I had to go through that long route because if I just told you to do them without showing you why they're important to the trader, you wouldn't do them. In other words, I had to take that long route to fix your philosophy. But the good news is, if you're still watching this video till now, your philosophy is already 80% fixed. Why? Because this is a ridiculously long video. And for you to sit through for this long, in this TikTok brain era that we live in, that means on some level, you're already subscribed to the philosophy discussed in this video. The make $200 million in a single trade crowd would have left in the first minute and gone to watch the next YouTube short. Being here till now means that if you put your mind to it, you can sit through pain without distracting yourself. This means your philosophy is already at 80%. You can sit still for 10 minutes every day to meditate. You can survive the pain of exercising because you already have a big anterior mid-cingulate cortex, and if you really wanted to, you could journal consistently. So you're already on your way to a strong trading mindset. And not only that, you're almost there. But to complete your journey, watch this next trading psychology deep dive on the illusion of time on trading. The video will help you solidify your philosophy. To go to the next level, you should also join our Telegram channel where we post everything trading psychology we can't post here on YouTube. Like the video, comment, subscribe to the channel, and turn on notifications so you don't miss the next deep dive video. Thanks for watching.